Good morning, everybody, and thank you very much for joining us on our latest No Limits community education session for the next half an hour. So if you've got up early after the long weekend, thank you very much for taking your time. If not, and you're watching a recorded version, also thank you very much for listening in, and I'm sure you're going to learn a lot over the next 30 minutes or so. But very quickly, my name's Gary Hales. I'm an action coach based in Dorset, and I've been coaching for over 20 years. And we're going to today talk about small business funding options and financing strategies. But before I do that, I'd just like to introduce my special guest today, Colin Aubrey from Money for Business. So, Colin, let me just pass across to you just a minute or so about yourself and your background. We'll be grateful. Thank you.
Hi, Gary.
Hey, Colin.
Thank you very much for the invite.
Pleasure.
I started with Barclays Bank many years ago, and where I really learnt my trade was as an underwriter in a credit committee in the early 90s. So right in the middle of a recession. So that was a very, very steep learning curve for me. I left Barclays at the beginning of 2000. So about half of my time was with Barclays, and now I'm a broker and have been for nearly 24 years. So lots and lots of experience, Gary.
Excellent. Great. Well, we're going to call upon that experience and knowledge, Colin. So thanks again for joining us. I guess the starting point is, funding for businesses. So that's whether a business is just started and classified as startup, which, I think startup could be classed as up to 3 years. I'm not 100% sure. Or whether you're looking to fund growth and expansion strategies. And there's been startup loans, there's been bounce back loans, I think there's recovery loans and all sorts of things out at the moment. Just at a very high level for business owners who are startup and looking to grow, what is available out on the market? What are the types of finances that people can opt for?
The first thing to say is that all lenders want to lend money. They can be seen as people that want to say no, computer says no, but they do want to lend money. So whether you're a startup or an established business, then there's funding out there. There's a certain way of applying for a loan that gets a higher rate of success, which we can talk about. But yeah, it's with a startup, I generally look at those as being within the first 12 months. And more established businesses, more than that. Yeah, so it's all available. There's many types of lenders, and pretty much they all want to help. Yeah.
And just to clarify, because there are some that are government funded versus government backed, like bounce back loans, etc., versus what a bank will lend you, which will probably be with a personal guarantee or so. What route do people go? Is it better to go with one of those sort of government funded ones or with their local bank? Is there a preference? You think one way is better than the other?
It's always best to do the research first, just to make sure what is available. The bounce back loan has come and gone. The coronavirus business interruption loan, this civil, that's come and gone. And now we're into the recovery loan scheme. Why the recovery loan scheme is very attractive to people is because it's the lenders have a 70% guarantee from the government. So they can take additional security, but it is government backed. So there's good schemes out there. Really, it'd be up to go to the lender and ask them for the money that you want, and just let them decide which route they want to go with it all. As you said in there, they may ask for personal guarantees. They could even ask for third-party security. Okay. So if you have somebody, if you don't have security yourself, and you know someone that is willing to give security, then they will consider that as well. But security is really the last thing they should be thinking of. It's more about whether you have a good business, what your commitment to it is, and most importantly, how you're going to service the loan when they agree.
Yeah. Okay. All right. That's great. Thanks for that. I guess sort of just slightly at a different tangent, is crowdfunding still an option, or is that not something that businesses would generally go down that route?
Very much so. That's generally unsecured. But the specialist lenders have come into the marketplace and taking some of the banks' share. I've mentioned lenders, not particularly banks, but the crowdfunding definitely is out there. It's a valuable way of getting funding. Generally speaking, it's shorter term and more expensive, but they're eating into the marketplace, and long may it continue. Yeah.
So there's quite a wide range of sources then, I guess, in terms of funding.
Very much so.
Yeah. Okay. So I guess, when somebody's looking at getting funding for their business, as you said, it's about doing the research. What are the keys to a successful application then? Is it different when you're submitting an application through a bank or through a different type of lender? What's key in a successful application?
There's no difference really to any lender that you approach. Most people, if not all, when you're speaking to somebody, they have to present a case to an underwriter. So you're giving that person the information that they need to be able to present your case and hopefully to a successful outcome. So always plan, understand what it is you think that the lender's policies are and how you're going to present to them. I'd be ready for questions. And the questions sometimes can be thought to be negative, but it's not really being negative. They know that they've got to present to an underwriter. They're going to get asked questions. So be ready for the questions. Use mitigating factors to make sure that you can answer those questions well. And then less is more, really. I've been in a lending role when I was a manager. Some people taught themselves out of deals. So present, answer questions, use mitigating factors, and just get out of there. Let them make the decision and present it to you. Yeah.
Okay. All right. A key thing, as a coach, I would say 80% of the clients that I start working with don't have a business plan. Is it important to have a business plan when you're looking at raising funds?
Well, I'm a believer that every business should have a business plan.
Totally, yeah.
So that doesn't have to be a massive, great document. It can be something that's a working document that all businesses work with to greater success. And that's why Action Coach is so good for people. Because I'm surprised that 80%, you said 80% don't have a
plan. Yeah.
Yeah. That's about right.
Yeah.
I was going to say, if they do, fair play. But when somebody goes to a lender, it's not really the business plan that they'll ask for a business plan, but really what they are more interested in is the financial information that is the part of the business plan. So that's the key aspect. And as responsible lenders, they want to make sure that they're comfortable that the borrower can service the debt. What's more important when approaching a lender, I think, is a funding plan. So I've got a 4-stage approach to that. It's the background to the business and the person, what they need the money for, how much is their deposit, how much do they want to borrow, serviceability, that's key. So the financial aspects from the business plan are the most important thing in the funding plan. And then safety. If the safety is supported with security, property, then that's ideal. But if there is no security, is there a personal guarantee involved? Are there people borrowing the monies personally? There'll always be an aspect of safety that they have to cover. So background, what's the requirement, serviceability and safety, and then all bases are covered then.
And when you say financial information, again, a lot of business owners I meet, that scares them. They run away from when it comes to financial information. They rely on their accountant, etc., which is understandable because they're good at what they do. And many haven't obviously got any that sort of financial education. But what do you tend to require? I assume last couple of years of accounts. Do they need profit and loss? Do they need balance sheets? Do they need forward projecting cash flows, which we focus on a lot in Action Coach? What sort of financial information do they need to pull together?
All of that, as you can imagine. What's most important, whether they do it themselves or via an accountant, is that they first of all have thought about what their business needs and what it wants and the assumptions behind those figures. A good accountant will want to know their assumptions, and from that, he or she can prepare the financial information. So, as you said, 3 years history of trading accounts, if indeed the business is that old. But so the historic trading accounts for the year end, the management accounts year to date, and if they're in the middle of a financial year, some forecasts to the end of that year, and then possibly one more year's financials after that, projections. And in an ideal world, those projections will be a monthly P&L, a monthly cash flow forecast, and a monthly balance sheet. That last one, the monthly balance sheets, I've always found that people, but even accountants, find it quite hard to construct the monthly balance sheets. So that's not necessarily the be all and end all, but definitely a monthly P&L and a monthly cash flow forecast.
Okay, great, excellent. And Colin, how long does the whole process take? Is it quite long-winded, requiring all those documents and business plans, etc.?
Doesn't have to be, but it can be quite a task preparing it all together, getting it all together. The work that if the person goes direct themselves, the work they do, or indeed a broker like me does for them, that will take several days. But if the person has all the information to hand and the accountant is quick about it, then a week or so to pull all that together.
Okay, all right. And you touched on it there, actually. Is it better to go direct to your bank, to a lender, or better to go through a broker? What's the pros and cons?
Of course, I'd recommend a broker. That's what I do. But somebody can go direct. The benefits of using a broker is that we know the lenders, we know what their policies are. If someone goes direct and it doesn't meet the lender's policy, there is absolutely no way that person is going to get the loan, because the lender's policy will dictate that it's not going to happen. So they can get dejected and think, oh, that's the end of it. But no, there are lots of lenders, as I said. So by going direct, the cases that I've seen aren't necessarily presented in the best possible way. They don't cover all the bases. They don't cover the mitigating factors that I mentioned earlier. And they don't sell themselves. And if it is a conversation rather than a written presentation, then people can talk too much. With us as brokers, we know the lenders, we know their policies, we can target particular lenders, and we get better deals. That's not just interest rates, fees, but it can include the length of the loan, interest-only options, capital repayment holidays, less security, no early repayment charges if the business is successful and wants to repay the loan. They're not always available, but we can negotiate and find the best lenders for people.
Wow. And the reason for wanting funding, so whether that's right at the beginning as a startup, whether it's for acquisition of another company, whether it's purchase of furniture or equipment or something like that, or it's for expansion through recruiting new staff and trying to help with cash flow and things like that. Does the criteria vary depending on the reason for the loan, or is it more about is it serviceable and what's the business look like, etc.?
Well, it's always about serviceability. That's the underlying factor about every loan application, because lenders have to demonstrate that they're responsible lenders. But as you say, there's different types of finance, so the criteria will range for different things. So I generally deal with commercial mortgages, so they are normally for trading businesses or property businesses. So the criteria for those will depend on the customer and what they want. The loan to value, so what deposit somebody has, is an important factor. Lenders will generally want to see what the owner's commitment is going to be to the project. If it's asset finance, then the criteria will change again. Typically, if someone wants to buy something with wheels on, at the moment, they may be able to get 100% finance. So for vehicles, they're shorter term loans, but that really is available to them. Then there's invoice finance. So if a client has a debtor book and the debtors money that's owed to the businesses are widespread, and they're if it's, say, a manufacturing company that delivers something, widgets to somebody, then there's a better chance of getting the funding for someone maybe like a building company that has to submit invoices for application to pay. So the invoice finance company may takes a different view on that. Their criteria is completely different. There's all sorts of other types of finance, trade finance, overseas finance. There's all sorts of different products out there, and for each type of finance, there's a different criteria. You're right. Yeah.
Okay. And obviously, a lot of businesses in their first year or 2 years will run at a loss. So their accounts will show a loss for the first year or two. Obviously, the accountant wants to keep the profits as low as possible to help with tax and things like that. So how is that looked at by lenders? Is it more about the future? You know, once they've received that investment and funding, the growth will go, you know, exponentially? Or is it the fact that you need to have a year or two's profit when the business is sort of in an early stage? What's the sort of view on that?
Generally speaking, they look at trends. So the better lenders will look at what's going on in the business trends. I often get businesses that have been on the decline for several years. They want to borrow money, and suddenly everything's going to turn around. Yeah, they are more difficult to get the finance for, those businesses. If people are making losses, which people do, and that is what the recovery loan scheme is there for, really. People have had a hard time over the last few years because of coronavirus. So the lenders will expect to see some downturn in there. But it's more about the trends. When the business starts and there's a lot of expense up front, then there will be some losses incurred potentially. But generally speaking, over the year or two that they've been trading, if those losses have reduced, things are getting better, and there's a real plan for the growth, then that's what they're more interested in. If that growth is exponential and a bit unrealistic, then they will ask questions why that's to be expected. So though profits are good, the projections are important. If it shows an upward tick, then I think that there are going to be more questions around that, why that's going to happen. But it's good to have some good projections in there.
Yeah. Okay. Another hot topic at the moment with the economy and things like that is interest rates. Obviously, they're quite high at the moment, hopefully starting to come down, etc. But are there good deals out there? Or, you know, you mentioned at the beginning that banks want to lend, but is it quite pricey? It does seem to be that way. And, you know, is it better to go to short-term fixed rates or long-term? You know, what's happening in the market in terms of interest rates?
Well, the lenders will argue that a base rate at 5.25% is back where it was, say, 15 years ago. So then the rate isn't expensive. That's their argument. But having had many years of very low interest rates, to people wanting to borrow money, it seems expensive. Interest rates at the moment, I've had some indicative rates come in just recently from a bank, and their 1 year cost of funds, so have to be careful here, because they will want to add a margin to their cost of funds in order for them to make a profit. Their 1 year rate is 6%, and their 10-year rate is 4.75%.
Okay.
Then there's the margin that goes on top of that, and they'll apply different margins for different industry sectors. And of course, if the loan is for a shorter term, then the repayments are going to be higher, of course, because it's got to be repaid over a shorter term, and that's where the serviceability comes in. Yeah. Okay. But there are some lenders, we talked about whether to go direct or via broker. Generally speaking, if somebody went to a bank, they're not going to get interest only. Maybe maybe for a year, for their first year, but not generally speaking. They want capital and interest. But there are lenders out there that will do 5-10 years interest only. And of course, by taking that option at a higher interest rate, maybe you're servicing the loan but not reducing it at all. So you've got to know how you're going to repay it at some point. Yeah. So to summarize that, interest rates are a bit higher than they have been, but they're still okay. And as you can tell from the first year rate, 1 year rate of 6% and a 10-year rate of 4.75 cost of funds, the economists, the specialists are expecting interest rates to come down now.
Yeah.
So
okay. Yeah, I was at a presentation a couple of weeks ago by somebody from the Bank of England, and they were sort of making that comment that obviously inflation is going to drop. It was above 10% then, so they had a more bullish long-term look at things, and so which is always good news that rates are getting better.
I don't want to get into politics particularly, but their inflation target of 2% or whatever it is, it does seem a bit optimistic, to say the least.
I'd agree with you there. It's a long way to go to get there. Just some other examples that come to mind, again, based on clients I work with. Occasionally, they've taken a few loans to get their business going. It's now been running sort of 3 years or so, 4 years, and they look at sort of consolidating and refinancing their existing debt and loans that they've taken. What is consolidation viewed like by lenders? Is it sort of not a good idea, rather stick with what you've got, or is consolidation a good angle to go down?
It's a good idea. And if someone can, I was talking about this to somebody at the weekend, lots of short-term loans that I think personally have been missold maybe by a broker or someone, and they're not thought about the long-term future. So to consolidate that debt, stretch it over a longer period, slightly lower interest rate to ease cash flow is a good idea.
Okay.
When you go to a lender though and say, please, can I consolidate these debts? Generally speaking, they're not that keen to do it. There has to be a good reason, and typically the reason will be that I'm struggling to afford them all, and that's not really what they want to hear. So if a business reconstruction can be used as the reason, borrow some more money maybe in there and consolidate at the same time. It's how to get that across to the lender in such a way that they don't want to be seen to repaying other people's other lenders' loans, which have been not missold, but shouldn't really been taken out in the first place.
Okay. So I guess the key is using a broker on that, so you go down the right way.
Always, Gary, always.
Absolutely. Another thing, again, as I mentioned at the beginning, I've got clients across all sorts of sectors. So, is there a sector that banks or lenders look upon more favorably than others? Is it retail? Is it construction? Any comments on preferred sectors?
They definitely have their preferred sectors. If you go to one extreme, the specialist lenders will only lend to one sector, and that's because that's what they specialize in. So property companies, development or investment property companies will generally go to the specialist lenders to get the best deals. If you're considering the lenders that are in the marketplace on a wider scale, such as banks, then they definitely have their preferred sectors. They like the professions, so doctors, dentists, healthcare, right the way through to, and manufacturing in there. They'd like engineering companies and manufacturers. And towards the lower end, because it is higher risk, I suppose, they've analysed their book and they understand where they lose more money and people struggle more, and it's more volatile. Down the lower end are things like hospitality, hotels, restaurants, cafes, that sort of thing. Yeah, but they definitely like different sectors, and it's priced accordingly.
Okay. And I guess sort of, again, we've touched on the sort of lending climate and situation, but post-COVID, is there still is COVID still a factor in things at the moment, or are lenders sort of now saying, well, COVID's in the history, it's not factored into any lending decisions? What's the sort of climate post-COVID?
It still is a factor. When they look at historic figures, they will see in the figures that turnover potentially has dipped. They'll match that to matrices that they have to see how that compares to other businesses in the industry sector. They'll look at the income that was generated from grants or payments by the government and see what percentage they were. And so it definitely is a factor, but that is less and less so now. And what is more of a factor is the businesses that took out the bounce back loans and the CBILS, the coronavirus business interruption loans. Those loans will probably still be in the balance sheet. And when it comes to serviceability, those loans can be quite large over a short period of time, which means that they've got to make a good level of profit and good cash flow to be able to cover the new debt they're looking for and the COVID loans, the BIBLs and the CBILS. Yeah, so, but it's less of an influence now, and businesses should be recovering well, depending on the industry sector. Yeah, one would hope.
Okay, great. Excellent. So thanks, Colin. We've got about 2 minutes left. So I just want to sort of bounce it back to you to sort of help summarize here. What would be the 2 or 3 key takeaways for business owners who are listening into this that they should bear in mind when they're looking at raising additional funding to help their business grow?
First of all, plan. So look at what you want the money for and how you're going to repay it. Yeah, there's the 4 headings that I use are background. So that is, what is the business? Who are the business owners? What experience do they have? Requirement, how much is what needed to borrow? What's the deposit? For what? What's the purpose? Who is the borrower? If it's a company, that's different from a partnership or a sole trader. Serviceability. So that is the key to it all. 3 years accounts, management accounts and some projections. And then safety. So the lender's want to know if it doesn't work out and the loan starts to, the borrower starts to struggle with the loan repayments and they have to call on the security, what is on offer? If it's a limited company that's borrowing the money, they'll always ask, are guarantees available? And the director's response to that should be yes, depending on what you require. It doesn't have to be for the full amount. So background, requirement, serviceability and safety, cover those 4 headings off, and a successful outcome will happen.
Brilliant. Thanks very much for that then, Colin. Just finally, a quick question. So if anybody's listening in and or watching the recorded version and want to ask a question or so, what are your contact details?
My name is Colin Aubrey. My email address is colin@money4business.net. That's with the number 4 in there. And my mobile number is 07881 430 255. And people can phone me at any time, Gary. I really don't mind.
Great. Thanks, Colin. And for others who want to get a question around the coaching side of things, you can reach out to me or your local coach. As I said, my name's Gary Hales, Gary Hales at actioncoach.co.uk, 077 369 44196. Please feel free to reach out to myself or Colin, and we'll be delighted to help you. So once again, thank you very much, Colin. Lovely to speak to you. And thank you
very much.
Valuable input. Really appreciate it.
Thank you, Karen. Thank you,
All right.
Gary.
Have a good day.
Thank you. And you. Bye-bye.